It's a presentation for ZCMC6112 financial statement analysis for decision making. The company that we have chosen is KPJ. It's a privilege to be here today to share insights into KPJ Healthcare Bhd, one of the Malaysia's foremost private healthcare providers. Established in 1981 as a subsidiary of Johor Corporation, KPJ has grown from its humble beginnings with a single hospital in Johor Bahru, where KPJ has grown largely nationally with focus areas such as hospitals, medical tourism, aged care, education, and also digital health. KPJ also took significant steps to enhance its healthcare system, with the government pledging to increase healthcare spending from 4 to 5% to 7% of the GDP. This ambitious move aims to strengthen infrastructure, improve services, and ensure better access to care, particularly in underserved rural areas. On the private side, the healthcare sector market size is growing, currently valued at around $3 to 4 billion, due to this growing demand for high quality, specialized, and faster services. Private hospitals generally cater to high-income patients and those seeking elective procedures, creating opportunities for premium revenue generations. On the financial front, KPJ is a testament to stability and growth. Listed on Bursa Malaysia, the company's robust business model has driven annual revenues exceeding 2 billion, with hospitals operations contributing significantly to its earnings. Medical tourism has also been a strategic success, attracting international patients seeking high quality yet cost-effective treatments. KPJ financial strength enables its invest in advanced medical technology and also digital solutions. This includes telemedicine platforms, digital patient records, and cutting-edge medical equipment that enhance operational efficiency and patient outcomes. By embracing innovation, KPJ is not only addressing current healthcare demands, but also preparing to meet the challenges on tomorrow. KPJ Healthcare Bhd is more than a healthcare provider. It's a leader shaping the future of the industry with its strong financial foundation, strategic investments, and also unwavering commitment to excellence. KPJ continues to deliver impactful solutions for Malaysia and beyond. I would like to pass on to Hann to present on the portal's 5 sources.
Thank you, Sudhit. So we have chosen to use the portal's 5 forces as the tool in which we do an external analysis of KPJ in terms of the context of the healthcare provider services in Malaysia. So of the 5 factors there, the first one that we looked at is the industrial rivalry, where we see that within the healthcare providers industry, the industry rivalry is very intense among the established healthcare providers. Healthcare services are highly regulated by the Ministry of Health in Malaysia. Hence, there are not that many services providers are they able to scale up and also to attain licenses and to be able to compete for the long term. Among the major competitors for KPJ Healthcare is the IHH Healthcare Group, Sunway Group, Columbia Asia, and also the public hospitals. So we see the industry has a strong push towards a brand differentiation between different players in order to try to compete to increase market share. In terms of the entrance of new competitors into the market as well, we see that it's an industry with very high barriers to enter. This is due to the fact that service providers like hospitals require a lot of capex investments in order to set up properly to compete. This includes investment in medical equipment, facilities, buildings, skill sets, and building up marketing campaigns in order to be able to be visible to the consumers. So it is a capex intensive and also an extremely high brand loyalty driven industry where patients and customers who are used to certain doctors or used to certain hospitals would tend to have a high tendency to repeat back going to the same medical care provider instead of jumping to different service providers. There also is the aspect of economics of scales that come into play as more and more patients are able to be able to contribute to revenues to pay back some of these capital intensive investments that hospitals are able to do. And hence, when you combine all of these, the challenge for new marketplace to enter into the market is something that's considered very high barrier for new entrants. The next analysis we did is on the supplier power, where we find that suppliers generally have a high to medium high level of power over the healthcare providers. This is driven by suppliers in the medical equipment specialization, pharmaceutical companies, and specialist service providers, all of whom have very specialized skill set. For example, with medical equipment suppliers, there are only a handful in the world, usually from first world countries like Japan or Germany or the US, that are able to make specialized equipment for the medical field that will meet the requirements of safety and reliability used for patient care. And this goes the same also for pharmaceuticals, where many of the top pharmaceutical companies in the world would have patents tied to their company, in which the healthcare providers would be obligated to use such medications in order to treat their patients. This is somewhat mitigated by generic drugs or older drugs, in which the service provider is able to use slightly lower cost items and reduce the power of these kind of pharmaceutical suppliers. And hence we find that as a supplier power, generally for healthcare providers, supplier power is considered high in terms of influencing the pricing and availability of services for healthcare providers. When we analyze the buyer power, we find that there are two distinct groups of buyers. One are corporate clients and one are individual patients, and they have different levels of power in terms of towards the service provider. For corporate clients, there is generally a higher power for negotiation due to the fact that they have volume. And when corporations or companies that group together in terms of negotiating benefits for their patients, we find that they are able to negotiate a better deal and lower prices compared to people who walk in. For individual patients, we find that they are lower negotiating power due to the fact that oftentimes when a patient goes to see a doctor, they are already requiring in need of urgent care, and this is the critical nature of healthcare services providers. So those are the two distinct differences of buyer power. And lastly, in terms of substitute and threat, we find that the largest threat to KPJ and private healthcare providers is the public healthcare sector in itself, which is heavily subsidized by the government. And through this one, many cost-conscious consumers will go to public healthcare systems instead of coming to private, or to elect for medical procedures that are non-urgent, which would allow them to source around for more cost-effective places to undergo treatment. Alternative medications like traditional Chinese medicine or traditional local medications are also a threat to the substitute, but although we see that this is only a partial substitute, as these kind of traditional healthcare services are seen more as a complementary service to the traditional healthcare services. Thank you. So I pass now to Sham. To Syahmi, sorry.
Hi everyone. So for KPJ Healthcare Financial Performance Overview, I will present from the financial year 2021 until 2023, where from the key performance metric, we can see that over the past 3 financial years, KPJ Healthcare has demonstrated strong growth and operational resilience despite challenge in healthcare industry. The company financial metric reveal consistent progress in revenue, profitability, and shareholder return. So next is revenue and profit trend. So KPJ revenue grows by 16.7% from 3 billion in financial year 2021 to 3.5 billion in financial year 2023. This growth has driven by increased patient volume, particularly from medical tourism and the expansion of hospital capacity, such as KPJ Damansara 2 and KPJ Penang. Net profit rose significantly by 202.6% from 100 million in financial year 2021 to 302.6 million in financial year 2023, reflecting improved operational efficiency and better utilization of hospital facilities. And next is the dividend shareholder value, where the KPJ has prioritized rewarding its shareholder as evidenced by a 6-fold increase in dividend per share from 55 cents in financial year 2021 to 3 ringgit and 35 cents in financial year 2023. This underscores the company's commitment to delivering value as its financial performance strengthened. Next is occupancy rate. The company hospitality occupancy rates improved significantly, rising from 42% in financial year 2021 to 67% in financial year 2023. This indicates better utilization of hospital resources and growing patient admission. KPJ Healthcare financial performance reflects its ability to adapt and thrive in a competitive healthcare environment. With its robust financial management focus on innovation, KPJ is well positioned to sustain long-term growth and strengthen its market leadership. So for the managing risk and SWOT analysis, I will pass to Sam to present.
Good afternoon, everyone. Okay, I'm Togaimalar going to present on managing risk on KPJs and also their mitigation strategies. So this managing risk we have classified under 5 key areas, which is operational risk, financial risk, regulatory and compliance risk, market risk, and cyber security risks. Under this operational risk, we have identified 3 major issues, which is potential equipment breakdown, raw material shortages, and utility disruption, which is KPJ overcome this by regular maintenance, stringent safety protocol, and investment in robust supply chain system. Secondly, shortage of suitable, qualified, and experienced staff, which is KPJ have their own human resource to address staff shortages, which is include salary review, adjustment, skill development, training program, new hiring, and etc. The third one will be delivery high quality customer focused healthcare services, which is implement strong clinical governance and maintenance compliance with standard, ensure effective issue resolution through structured framework and collaboration with health authorities. The secondly will be financial risk, which is raising energy tariff and inflation. Wages increase have added significant financial pressure on KPJ operation. The minimum wages in Malaysia was raised by 25% in May 2022, while natural gas prices also surged by approximately 60% during the same period. So KPJ uses cost management strategies to local sourcing of material and implementing digital technologies to optimize process and reduce the cost. This help them cushion their financial impact of raising operational expenses. The third one will be regulatory and compliance risks, which is highly regulated with standard evolving to ensure patient safety, environmental sustainability, and ethical practices. Non-compliance can lead to the penalties, reputational damage, and also operational disruption. KPJ have established a dedicated compliance department to monitor this, enforce adherence both local and international regulation, and this proactive approach ensure their organization meet stringent healthcare and safety standard consistently. And the fourth one will be market risk, which is increasing competition from regional and domestic healthcare providers poses a challenge for KPJ in maintaining market share and revenue growth. Competitors are actively expanding their service portfolios and also capacities. So the KPJ focus on the differentiating itself by leveraging its strong brand presence, expanding its health tourism initiative, and diversifying its service offering. These strategies enhance the KPJ's competitive and advantage and capturing their new customer segment. The last one will be cyber security, which is increasing reliance on digital platform, including telemedic, the hospital information system, exposes the KPJ potential data breaches and cyber attacks. KPJ upgrades its IT infrastructures, enhance security protocol, and conduct regular employee training to mitigate the cyber security, which is to ensure the protection of sensitive patient information and operational resilience in digital era. Next one will be the SWOT analysis. Their strength will be they are established in market more than 40 years of expertise, which is with 28 facilities in Malaysia alone. The second one will be comprehensive service offering, including hospital operation, ambulatory care, diagnostic, and health tourism, which is inpatient care to outpatient service like dentistry, rehabilitation, and homeodialysis. The third one will be commitment to innovation and digitalization, which is KPJ's invested in next generation hospital information system and telemedic platform to enhance operational efficiency and improve patients' outcomes. but their weakness will be raising operational costs due to increased wages and energy tariff, which is earlier say 25%. This is impacting their overall profitability. And high dependency on local revenue, approximately 98% of KPJ revenue is derived from Malaysian operation, limiting its diversification across international market. And the third one will be heavy capital expenditure requirement for hospital expansion and maintenance, which is upgrading existing facilities, expanding capacity, and implementing new technology. Their opportunities are raising healthcare demand driven by demographic trends and increasing public awareness of health issues. Yeah, the prevalence of chronic disease and health consciousness among Malaysian further fuels their growth. And also health tourism growth, which is KPJ recorded 41% increase in health revenue for the year 2023, which is supported by Malaysia global reputation for affordable, high quality healthcare service and proximity to key market like Asia and MENA. Their threat will be competition from regional and local healthcare provider. Both domestic player and international hospital groups are aggressively expanding in Malaysia, increasing competition for the market share. And also regulatory compliance like evolving standard such as compliance with international healthcare standard and waste management regulation. Thank you. I pass the presentation to Sham.
So hi, thank you, Sam. So I will be presenting the financial statement analysis. So firstly, on the next slide, we have a visual representative of the increase in sales and cost of analysis and cost of sales over the time. So this increase in sales from 2.6 billion in 2021 to 3.4 billion in 2023 considerably a high decent increase in their business, which contribute to the growth of the company over the time. Besides, it contributes to a healthy increase in the cost of sales, along with the increase in sales from 1.6 billion in 2021 to 1.9 billion in 2023. This growth in the sales is attributed by increase in patient volume, especially from healthcare tourism to Malaysia, which grew from 297,000 to 350,000, and increase in surgery case by 11% during this period. Moreover, this growth also attributed by KPJ's expansion of facilities like KPJ Damansara 2 and KPJ Penang, which boost their revenue from the utilization of their new assets. And on the before part, so we have the gross and net profit margin. So this graph representative show the steady increase in the gross profit from 940 million in 2021 to 1.4 billion in 2023, reflecting a higher revenue growth and operational improvement. This rise in efficiency is contributed by increasing revenue stream, where the company saw a higher hospital admission and operation visit post-pandemic. This led to a better utilization of hospital facilities and service. Besides, KPJ adopt a smart hospital system, which include digital patient management and other operational enhancement, which also contribute to the optimization of their resources use and improve their profit margins. And on the net profit of the company, it shows an increasing trend from 65 million in 2021 to 182 million in 2022 and 270 million in 2023. This 2021 performance is due to COVID-19 pandemic, where the outbreak was significant and there is loose in the movement restriction, and also contribute to a higher tax benefit during this period. And on the next slide, we have the administrative expenditure analysis. The graphs show the visual representative of the steady increase in the administrative expenditure, which contribute to lower net profit in 2023. So the administrative expenditure increased from 7 to 8 million in 2021 to 980 million in 2023. The rise in expenditure aligned with KPJ's overall expansion effort, which include increase in personal expense, investment in healthcare facilities, and inflationary pressure. Additionally, the company's growing scale and activities may have contributed to higher general and administrative expense. And during this period also, KPJ has increased its marketing strategy to attract patients and enhance its brand image, which contribute to the higher expense in 2023. And on the next slide, I will be presenting the common size analysis. So the common size analysis present financial statement item as percentage of common base. So the common size analysis from 2021 to 2023 reveals several notable trends in the comprehensive income statement. The gross profit margin steadily improved from 36% in 2021 to 42% in 2023, reflecting better cost management and operational efficiency, likely driven by reduce in cost of sales from 64% to 58%. However, the administrative expense, which are stable at around 27% to 29% of revenue, suggests that their overhead cost has not proportionately decreased despite revenue growth. This, coupled with increase in operating profit margin from 9% in 2021 to 15% in 2023. Similarly, the profit before tax and net profit margin both increased significantly, with net profit margin increased from 2% in 2021 to 6% in 2022 before growth further 8% in 2023. So these trends suggest that KPJ is effectively growing its revenue and improving gross profitability, rising expense tied to growth initiative, and potentially financing costs have compressed overall profitability, requiring a focused effort on optimizing non-operational expense to sustain long-term earning growth. So that's all for me. I will pass to Chong to present ratio analysis. Thank you.
Hi, thank you, Sham. So first and foremost, I'd like to start with the ratio analysis from the profitability ratio point of view. First and foremost, we look at the gross profit margin, operating profit margin, net profit margin, EBIT margin of KPJ Healthcare Bhd. At a glance, we see that there has been steady profitability growth across all the metrics. They have all grown steadily across the financial year 2021 to 2023. First and foremost, the gross profit margin, as mentioned in the previous section, has increased steadily from about 36% to 42%, reflecting improved revenue relative to costs. Secondly, the operating or EBIT margins also grew significantly, with EBIT margins reaching 16.46% in 2023, indicating better operational efficiency. And also net profit margin rose from 2.95% to 9.05%, an almost threefold increase driven by higher sales and slower growth in operating costs. The overall efficiency is also seen to be high, thanks to enhanced cost control, and rising sales contributed to higher margins across all profitability ratios. Next, we go to liquidity ratios. And again, just like profitability ratios, we see that across the board, it has increased quite healthily. First and foremost, the current ratio, we see it rose from 61.3% to 121.27%, indicating that KPJ Healthcare Bhd current assets exceeded current liabilities for the first time . 5.85%, again mirroring the rise in current ratio, showcasing efficient asset management. Thirdly, we have the cash ratio, and it jumped from 20.13% to 58.29%, which is nearly triple. This highlights a strategic focus, a shift from holding all sorts of assets to a more focus on cash reserves. So all in all, the liquidity assessment for KPJ Healthcare Bhd is that the current assets, especially cash, could comfortably cover liabilities up to 60%, whereas their current ratio is more than enough to cover their liabilities. So generally, very good, very healthy liquidity. So moving on, the third ratio, the third category we are looking at is the working capital ratios, and this is measured in both, in the graph it's measured in days, but we have figures for both in figures and in days. So let's start with the account receivable turnover. It declined from 5.66 to 5.18, showing a slight worsening, but the following this, the days receivable outstanding, DRO, 4.49 days to 70.43 days, indicating slower receivables collection. And moving on to the accounts payable turnover, it fluctuated from 2.7 to 2.62, and then it improved to 2.88. So following this, the days payable outstanding ranges from 132.36 days to 126 0.63 days, showing consistent, well, small fluctuations, but mostly stable around the 128-day mark for the accounts payable. Thirdly, the inventory turnover, we see that it dropped from 31.88 to 28.61, increasing the days inventory outstanding from 11.45 days to 12.76 days, reflecting a slightly slower inventory movement. And then we can combine the CCC, or the cash conversion cycle, with the net trade cycle, NTC. Cash conversion cycle moved from negative 56.42 days to negative 43.44 days. And the net trade cycle similarly decreased from negative 64.87 days to negative 56.2 days, maintaining a strong negative position, which signifies very efficient, very strong supplier terms and very good cash flow management. So moving on to the next category of ratios is the operating return ratios. First, we look at the ROE, return on equity, and return on asset ROA growth. We see that return on equity rose from 3.44% to 12.24%, whereas the return on assets increased from 1.25% to 4.24%, nearly tripling over the 3-year period, indicating effective asset utilization and strong operating returns. Secondly, we have the equity multiplier, which fluctuated between 2.75 to 2.97, showing consistent reliance on leveraging on the equity. And next, we have the asset turnover, and it varied slightly, but mostly stably, in the 42.45% range to the 47.18%, with fluctuations under 10% of each other. So this suggests that there's a stable efficiency in generating revenue from their assets. And then we have the high leverage. We see that the equity multiplier is around 2.97 times, which is near 3 times, and it highlights a relatively high risk appetite, a more expansionist point of view from KPJ Healthcare Bhd. But though this is not inherently problematic, so it's not a red flag. So we can, in summary, we see that the ROE and ROA are still strong and increasing consistently, and the leverage is still within acceptable region. Lastly, we have the leverage ratios. First and foremost, the debt to equity trends shows that it fluctuates slightly between 0.81 to 0.76, whereas long-term debt to equity has increased from 0.43 to 0.45, and this is a significant increase, indicating a shift towards higher long-term debt. The leverage interpretation, although the leverage ratio shows that it's about 0.81 or 0.6, this is a bit of a false image, because the equity multiplier from the previous category reveals that the real leverage is about 3 times instead of less than 1 as suggested here. The time interest earned also shows that improved from 1.73 to 3.05 times, driven by stable financing costs and rising profits, reflecting enhanced ability to cover our interest obligations, our financing obligations. And so to cap this all off, we see that the risk appetite generally demonstrated by KPJ Healthcare Bhd in their higher long-term debt and equity multiplier shows a greater risk appetite, although the leverage remains manageable, within a manageable range. So in summary, yes, KPJ Healthcare Bhd has excellent financial ratios across the board, and although they have a higher risk appetite, this has been successful so far and seems to be sustainable. So moving on to the cash flow analysis part, I'd like to pass the stage back to my teammate, Jason.
All right, thank you, Chong. So I'm Jason. So this is basically this slide is showing the consolidated cash flow statement for KPJ from fiscal year 2021 to 2023. So from the table above, we can actually see that KPJ's cash flow from operations has an increasing trend throughout 2021 to 2023, which means that KPJ is making more money from its business activities. So cash flow from investing has also improved as well, and it can be seen that a positive value is seen in 2023. So this is basically a result from KPJ's stable investment in their capex or capex expenditures. As we can see here, they actually invested more than 200 million ringgit every year. So fluctuating cash used in financing can be seen as well in the table, and it reaches its peak at 2023. So the main reason is basically because of the increased dividends paid since 2022 and also a stable debt repayment since 2021. So moving on next, we will be talking about the net changes in cash. So it can be seen here, it is also fluctuating because even though it's fluctuating, it's a healthy outlook that the value actually got double up in fiscal year 2022 and 2023 as compared to fiscal year 2021. So lastly, for the cash flow adequacy ratio, although the value for all 3 years is below 1 and is showing a fluctuating trend, it's still a positive sign for KPJ that the ratio in 2023 improved as compared to 2022 and 2021. So next slide. So as a key takeaway, we will sum up the presentation today. Let's discuss on KPJ's strong operational performance. So over the past 3 years, KPJ have seen consistent growth in their operational cash flow, which increased from 412 million in 2021 to 657 million in 2023. So this growth actually reflects KPJ's core businesses are actually generating increased cash, and it's also showing that they have a high operational efficiency and also profitability. As a result, this surge in the revenue and optimized working capital are also a sign of their KPJ's post-pandemic recovery. So moving on next to the second point, KPJ can also be attributed for their strategic investments for growth. So KPJ actually has a significant investment on their CapEx, which is also known as capital expenditure over the last 3 years. As we can see from their financial statement previously, they have invested quite a high number on their CapEx, which is 200 million on average. This investment actually essential for expanding KPJ's operations and also upgrading their infrastructure to maintain competitiveness and also meet the growing demand in the industry. Lastly, let's look at KPJ's prudent financial management. So KPJ actually embraces a proactive approach to their debt reduction, and this action can be seen in KPJ's recent debt repayment of 691 million in 2023, which helps to further enhance KPJ's financial stability and also reduce financial risk. While additionally, KPJ have also increased dividend payments to their shareholders. This reflects that they have improved profitability and also showing commitment that to return value to their investors. So to sum up today's presentation, looking ahead, KPJ has a strong positive outlook on their growth trajectory with a solid foundation built on strong operational performance and strategic investments. So KPJ is actually a well-positioned company to navigate for further challenges and when we'll capitalize on opportunities within the market. All right, thank you for that. That's end of our presentation today.
Thank you. That concludes it.